in the emerging market, things can be very, very, very different. One can trade at single-digit multiple, one can trade at high-teen multiple. Broader markets is trading at mid double-digit markets. It can be very, very varied outcomes in emerging market. Yes, China is cheap, there is no doubt about it. But there are significant headwinds also that China has to face at this point of time. Their growth is slowing down. Their growth is dramatically slowing down. When you look at nominal GDP growth, we are penciling in around 10 to 11% nominal GDP growth for India. When you look at consensus numbers for China, the number is more like 4 to 6%. So in nominal terms, India is looking to outgrow China by 2x over the next 3-4 years.
Now, but that's a $19 trillion economy. This is a $4 trillion economy nearly.
Of course, base makes a big difference. So base is catching up with China in some ways.
It is, and so, people miss that out.
And of course, demographics are also catching up. And the trade war that we are not looking for, but it's happening right in front of us. Hopefully, India is a better place. So yeah, I think in that sense, this product launch of MSCI India is rightly timed. We are, as asset managers in India, we have a mutual fund in India for local investors. We at Kotak International cater to global investors. For us, it was time to introduce a new product to Indian audience and also to global audience, the same product which they've been used to in a more efficient manner by launching this ETF that our fund is doing, mutual fund is doing in India. And we are also launching a fund in Mauritius to feed into that underlying ETF.
Okay, so an investor told me that just having an upgrade in the MSCI EM index, India has gone from 8% to now like 13-14%, right?
19%.
Oh yeah, sorry, I'm completely mistaken. Yes, it went actually all the way up to 25% and now has come down to 19%. So you're right. So the weighting of India's, so the India weighting on the EM index has gone up significantly because of where the market is, but its weighting in the global index is still around 1-2%. It's
less than 2%.
Yeah. So it's shifted marginally.
Yes.
Right? How do you get global investors based out of the US to invest in India? Because 70% of that index is just US. 70-80% of that index is just US.
It's a tough ask.
And it's the game in town.
It's a tough ask right now. When you think about it, the US 10-year paper is yielding you 4.5%. That's risk-free dollar return, right, in some ways. Donald Trump is, on one side there is trade war, tariff war. On the other side is deregulation, tax cuts. So it's all about the U.S. economy in a sweet spot. So for us as emerging market, we have to offer something more. And at the same time, we are seeing dollar strength. Emerging market currency are very, very volatile. We have seen rupee also losing steam in the last few months. So I think in that sense, it's a tough ask. But that said, ultimately it is long-term growth which will attract investors to a market like India. And when you look at India versus global growth, we are quite confident that India will be between 6 and 7% for the next 5-6 years, and global growth will struggle between 3 and 4 years. Developed market will be between 2 and 3 percentage point at best. So in that sense, if you take a slightly longer term view, India offers a very strong outlook to growth with a diversified market. Again, going back to MSCI, when you look at emerging markets, they're very skewed in sectors. Skewed. India is one of the very few markets which is well diversified, very liquid, and wide.